Good morning, I'm Vince Lancy. This is the morning market rundown, and hope everyone's doing well. 10-year yields are 433, up one, almost two. The dollar is 103.82, up 25. The S&P 500 is 55.76, down 16. The VIX is 24.62, up 40-ish. Gold is 29.47, up 14, just a shot away. Silver is 33.11, probably being financed for the gold. Copper is down a penny at 477. WTI 67.31, down 47. Natural gas is 408, down a penny. Bitcoin is 82,900, down 650. Palladium 941, platinum 974, down 8, down 9, and change. Gold, silver below 90, 88, 90-ish. Soy, corn, and wheat 995, 454, 563. All three of them are up. In percentage terms, wheat's up the most. Okay, so what are we going to talk about today? Well, I guess we'll talk about gold, right? And silver. All right. So 3,000 is just a shot away. That's related to an accumulation pattern that I've been seeing for the last 2 years, that it's happening again. And we'll look at a chart or two on that, along with some levels that I have. But anyway, today we will be covering UBS and a UBS report and cap and trade markets that I'm seeing in charts. And in premium, we have a UBS essentially buying the dip in silver, copper, and oil, and staying the course in gold. All right. Front page. Why is JP Morgan's Gold Vault next to the New York Feds? That's a Zero Hedge Classic post behind their paywall. We explain some of that in context of this daisy chain concept, which has crept up in the silver community on X, of which I am a part, uh, surrounding ETFs, surrounding shorting ETFs, and uh, co-opting the metal from ETFs to satisfy physical delivery with regards to SLV, PSLV, and the relative difficulty in doing that with PSLV, shorting the shares, I should say, and all the things related to that, which maybe we'll do a post on another time. But just shout out to those guys for doing that, because Bob Coleman and Semper Vigilante, whatever his name is, good guy. Anyway, that's the thing that made me throw this post up again, because it's all related to the daisy chain concept, which is a sub theme of the post. Special, all gold is monetary gold. That's just a brain moment that I had that I think is relevant. JP Morgan had a report out on GDP being weaker because of front loading of commodity. I'm sorry, GDP being weaker because gold purchase is understating it, implying that gold is an economic good. The point is that the government and the agencies that they use will define gold as non-monetary unless it's in a very specific bar and format. The truth is, all gold is monetary gold. If you just give it a steam bath at Metalore over in Massachusetts, it's monetary gold. And that's what they're doing. They're bringing back gold for monetary purposes. Gold, the gun bankers pretend they don't need, but can't live without. We have that out there at Scottsdale under a different title. We suggest you read it. Okay, so discussion. UBS buys the dip in silver, copper, and oil. Title of the report is Trade Threats Mask a Long-Term Outlook. Now, that's a commodity update. It's about commodities in general, but they're increasingly giving more and more time to precious metals. So let me read a little excerpt from that. The steady rise in commodity prices from the start of the year has come to an abrupt halt. Growth uncertainty in commodity-specific factors, mainly on the grain side, have caused a price consolidation at a broad asset class level. We think tariff-induced risks, which seem to have less market impact, remain a short-term concern. Now, you'll notice as I'm saying this, if you're a metals person, you're like, I don't see it. I don't see it. I don't see it. Right. Exactly. That's where the whole front loading concept comes in, or what I would call front running. So they're talking about commodities in general. Oil has taken a hit, right? So oil falls under this category. So they continue. However, we remain positive on the commodity asset class. We like crude oil for volatility selling strategies. That means sell put spreads or sell or buy butterflies. They think the market's in a range and near a bottom. Gold's return outlook, they're basically saying stay the course with gold, although limited in our base case, meaning they don't think it's going to go up much more, but they're certainly not deconstructive on it. Uh, and its ability to adverse and asset in adverse times are still appealing to us. Silver should outperform gold alongside copper in our base case of a modest recovery in manufacturing activity. Now, that that doesn't the whole report is it's not institutional, but it's a very good report because especially in the metals area, it goes through all the drivers without rehashing someone else's work. They add insights to supply chain issues. There are supply chain issues, and that's why prices are going up. Trump tariffs, you would think, I'm paraphrasing them, you would think Trump's tariffs would not have an effect on precious metals, but their word, ironically, they do. So I'm saying you it's not ironic, but that's neither here nor there. They're making the point that, precious metals are not a consumed asset. And so there shouldn't be front running of precious metals for tariffs because they're monetary. And yet they are being front loaded is the word they use. UK vault problems. Without getting too specific, they're frank that the UK is having problems doing its job, emptying the vault. I guess precious metals are heavy, I hear. Silver dynamics are more complicated. I think that's an interesting comment. I'm going to throw a little light on that. We like gold because of this. Okay. Silver's dynamics are more complicated, and silver's dynamics are more complicated. That's not a shade throwing comment. What they're saying is silver is largely an industrial metal, and therefore, if the trade tariffs, the front running or front loading, I should say, of commodities is over, silver should depress along with other economic assets that are tied to tariffs, right? Okay, so if the economy slows down, silver demand will slow down. Okay, it's more complicated because, and this kind of throws gold in there as well, because if tariffs become a big permanent thing, you know what's going to happen? Bazookas are going to become a big permanent thing everywhere else. So China, India, whatever, they're just going to print more. They're just going to be like, all right, fine. You're going to make us $1 more, then we're going to just create more yuan. That's the reaction. You're seeing that already. Tariffs beget fiscal and monetary stimulus overseas, fiscal mostly. Capital controls get eased, what have you. And you're going to see that, and it becomes a race where we're exporting recession, right? Or deflation, and they're exporting inflation. So if we win, it's Goldilocks. If they win or the world loses, or if well, the world's going to lose anyway, probably, right? If it doesn't work out the way, if everyone wins, right? If everyone wins, if we win and they win, you get stagflation, right? You get the price of things going up because China's going, shit, I'll just buy it anyway, right? And the dollar keeps going up because everyone goes, shit, I need more dollars. So you get stocks dropping, commodities reasserting themselves. Anyway, long version of what I'm trying to say is that silver will take industrial hits, but will be supported by global monetary fiscal spending to compensate for tariffs. So we're just in a Goldilocks, era now. That's really it. It just doesn't look it in price, but compared to gold, but it's really getting there. All right. Central bank purchases gives you an update on that and what have you. And there's one of the charts. This is one of the charts showing that ETF inflows have increased. Now, in the context of what's going on right now with stocks selling off and gold rallying and silver, also rallying and copper also rallying. Uh, The 60/40 portfolio is something that Jordan talks about a lot, but in general, we all are aware of the underperformance of gold and gold miners and silver miners relative to stocks, whether it be stocks or the Mag 7 or the 60/40 portfolio. This could be the beginning of the real long secular change coming in to that. Every other correlation in the world has broken down, except stocks have outperformed. So look at this chart. This is the flows of US money going into, well, European money too, going into the gold ETF, even as stocks are on the highs. So what happens if PPI today, which is due out in 2 minutes, is incredibly inflationary? I'm not saying it will be, but it's incredibly inflationary. Then all of a sudden the stagflation theme gets bigger. And every time stocks drop, people will buy a little bit more gold. People will buy a little bit, hopefully, they'll buy a little bit more miners. And the whole rotation changes. The next time up, stocks go up 3%. Gold and silver go up 5%. So the 60/40 portfolio, the stock, we're entering into the biggest risk of a stagflationary era since the 1970s. Period. End of story. And if you don't believe me, there's a portfolio by Goldman Sachs out there. It's a stagflationary portfolio, and they put together these products for their clients. There's demand for it. They put together, or they think it's going to go up. They put it together. So they're making a product, but they're also making something that's convenient to invest in. And the success of the product is based on how good they are picking the right equities. And when they pick the Trump basket, the Democrat basket versus the Republican basket, it moved like a perfect poll of the two candidates running for president. And since then, the Trump basket is sold off, right? So now you have a stagflationary basket. So every time stagflation becomes a bigger concern, you're going to see this, tying it in with, again, Michael Hartnett, who said over several months, he said, be careful, heads up when, the Mag 7 is number one and gold is number two, basically. That's what he keeps saying, tech stocks, gold. He goes, in the next rally, if you see leadership change, if you see gold outperform tech stocks in the next rally, then all bets are off for the stock market. And all bets are probably on for miners. Anyway, data on deck, CPI this week, PPI, and PPI is out right now. And you can watch the market while I'm looking at that. It looks like it's gyrating a little bit. Fine. Let's move on to the summary and final market check. The summary is commodities, generally speaking, are softer because of the fears of tariffs slowing the global economy down. However, those tariffs will be met if they become permanent with an increase in fiscal stimulus by global entities in order to fight the tariffs. Therefore, gold and silver are being bought in anticipation of this reaction. Ultimately, if tariffs are permanent, gold will go up because it'll just make people more nervous about sanctions, which lead to confiscation of wealth. Silver will follow suit because China keeps buying it and they will stimulate even more to support the market. We're in a stagflationary war. We're on the cusp of a major stagflation. That's my opinion. All right, so let's see. 31, gold is still up 12, 13. Watch stocks and watch the dollar, right? Gold's not going to key off the dollar. Silver's going to key off of stocks, at least initially. So while you're looking at that, let me put this chart up. This is the gold chart for weeklies. And it feels like we're in another one of those trapped, captured areas. And excuse me, I have an itch. Anyway, over a period of years, I've observed when the gold market is capped, all those rectangles except one, I'm sure, as sure as I can be, that the Bank of International Settlements was involved in keeping a lid on it. It's kind of like a circuit breaker, right? So you can't see the years there, but in 2020, 2021, capped. And then look at the yellow arrow, right? 2022, second rectangle, That's when the war started in Ukraine, Russia, capped, and then the sell-off continued because during that time it was severe, and but that was also when we started fighting inflation, right?